All right, good morning, everybody. If we can spend the next minute gathering, and committee members, if you guys will come on up and take a seat. Now I know what my pastor feels like on Sunday mornings, transitioning between Sunday school and the good hour, as we call it. Thank you all for being here today, and I appreciate it. Before we get started, just a little bit of housekeeping. I'm going to allow each of the committee members to do a brief introduction of themselves and their background. And again, I'll say brief to the Baptists in the room. I'll say really brief, and look forward to hearing from everybody and having a good discussion today. For the committee members, we're going to try to move through today's presentation quickly, but we also want to make sure that we have time for question and answers. So the run of show is going to be, we've got three presentations, and after each presentation, we'll have 10-15 minutes for Q&A between the committee members and those presenters. This is a hearing only today. We're not planning on taking any specific public comment. That will be reserved for a future meeting. This is more informational, the big picture of interchange and all the component parts. And today's speakers, I think, will bring different perspectives to that. Also, committee members, we do have a lunch that is going to be provided to you. It'll be in room 510 that you will be able to stay and eat there if you want to network and stick around. But if you've got other commitments, I think it'll be an option for grab and go as well. So with that, I would like to ask Noel Williams, I didn't give him a heads up, to open us in an invocation. But before I do that, I want to have a moment of silence for something. I want to announce this. Many of you may have seen this recently, and our Governor Kemp, announced this. But tomorrow, the flags on the state capitol will be at half staff. Also in Carroll County, Investigator Taylor Jamison Bristow, 30, unfortunately succumbed to injuries received in the line of duty. And I just think for his family and that community, I know it's a tough time. And if you would, we'll just have a moment of silence for him. And then, Noel, I'll turn it over to you for an opening prayer. Okay? All right. Go ahead. Thank you for all your many blessings of life. Father, we come to you with hearts that are full of sadness for this family, for the tragic loss of this Carrollton deputy. Father, we ask you to hold this family in the palm of your hand. And we ask you to be with this group, be with everyone in this room, help us to do things that are pleasing to you, and be with us this Labor Day weekend, and give us traveling mercy. We pray all these things in Jesus' name. Amen. Amen. All right, so I'll officially call the HR 1135 House Study Committee for interchange and swipe fees to order. And at this time, I'd like each committee member, we'll start over to my left and have each committee member introduce themselves. So we've got some mics going on. So tell me your number and you'll just hit the button out here. 13.
My name is Joe Ruland. I live and work in Statesboro, Georgia. I am the chair and a professor of finance at Georgia Southern University.
15. My name is Terry Cummings. I'm Representative District 39, which is Mableton and Smyrna. My background is legal and law enforcement, but I'm here because my interest with credit card transactions involve mainly the consumer. Thank you.
Hi, Kevin Carroll with Racetrack, where I lead the payments team. Background in payments for over 25 years at banks, processors, 14 years at a network MasterCard, and working at merchants as well.
Thank you. CB?
CB Yadav from St. Mary, Georgia. I have multiple businesses. I own the hotels and 5-6 and some restaurant and grocery store.
Okay, thank you.
Hi, good morning. Todd Jones, House District 25, the best district in the state, South Forsyth County and North Fulton. Thank you.
Noel Williams, House District 148. I think Todd is a bunch of transplants. I don't think they're real Georgians. But anyway, glad to be here, and I look forward to giving my friend Todd a hard time today. Thank you.
I'm glad they sat next to each other. All right. Number?
Gina McCollum, Gainesville, Georgia, and I've been in the payments industry for about 35 years, and I'm looking forward to serving on the committee.
All right. Thank you very much. And we have two folks online. We've got Wayne Atkins.
Good morning. Wayne Atkins with Synovus Bank. Have responsibility for our payments business. I've been in the industry about 37 years.
All right. And Laura Lanier.
Hey, good morning. I'm Laura Lanier, also from Statesboro. I've owned and operated several small businesses over the years and currently own and operate a clothing business.
All right. Thank you very much for being a part of this. And I want to also introduce, I know he doesn't want to have any attention, but David Hartman's here. He's helping us. He's one of the ones that have helped put this meeting together. It's helping our folks that are presenting online through Zoom, and also has provided you guys with all the information today, as well as copies of all of the PowerPoints, so that you can consume the presentations at whatever is best for you, whether it's looking up at the screen or in front of you. So thank you again for being here and taking copious notes as well. At this time, we're going to ask Julian Morris, who is a senior scholar of the International Center for Law and Economics, to make his presentation. So I think he's going to be doing that via Zoom. And we'd like to welcome him to our study committee.
Am I coming through? Hi.
We should be able to hear you.
Can you hear me now?
Yes.
Okay, great. I'm glad that you've shared my PowerPoint presentation, because I'm now having trouble sharing it, which is a delightful error. No, can't see it at all. Sorry, I'm on a MacBook, which I'm not usually using. So anyway, so maybe someone there could share like the first screen of the PowerPoint.
Yeah, we've got it shared on the screen.
Okay. Brilliant. Well, I'll just assume that you're seeing what I'm seeing, and stop trying to share. Okay, brilliant. So I got it. Thank you very much for doing this. So I'm going to take you through. I know that some of you know a lot about interchange. Some of you know probably more than me about interchange. Others of you maybe know less. My purpose here is not to talk about so much the mechanics of interchange, although I will talk about that. I'm going to talk largely about the economics of interchange. So if you go to the next screen, so I'm going to talk about payments, network effects, and two-sided markets. I'll explain what all that is in a minute. I'll then talk about the role of what are called cross-side subsidies in two-sided markets, and then I'll talk about the difference between, or the way in which these work, but also the differences between 3- and 4-party payment networks. And I'll explain what those are for those who don't know. Then I'll go into some more detail as to why interchange fees exist and what they cover. That I'll try and relate that back to the earlier explanation of two-sided markets. And then I'm going to talk about bilateral versus multilateral interchange, or the more generally kind of why multilateral interchange fees exist. And then finally, I'm going to talk a little bit about, actually that's the last slide is really about merchant discount rate and the relationship between merchant discount rate and interchange fees. So let's get going. I'm sorry, I'm a bit, I'm still in the midst of COVID, so I'm also not 100% compos mentis, but I'm going to do my best to get through this. So if we can go to slide 3, please. Most products, so let's just start with what makes for a successful product. And the evidence is clear that most products really only become viable once you're able to produce them at a certain scale, right? So if below a certain scale, it's not cost effective to be selling a product. I'm happy to go into that in more detail, but that's really a prelude to observing that in some markets, there are these network effects whereby the more of a product that's bought by, sorry, the more consumers that buy a product, the higher the value that product has for other consumers. So an early example of this would have been VHS cassette tapes, where the more people who had VHS cassette tapes, the more value those individual tapes had to each person because they could be shared. More recently, we've seen this a sort of an explosion in the number of products that have these network effects with the emergence of social networks and other online activities. So the more people who are on Facebook, the more value it has. And Facebook was able to outcompete MySpace because it had characteristics that were desirable, that more desirable than MySpace, and MySpace basically stopped having much of a market because it lost to the network effects of Facebook. The same is true for other social networks like X and TikTok and so on. Now, when it comes to payment systems, these also have network effects, but they're a bit different because they rely not so much on simply the one side, the buyers or the sellers, having a large number of participants, but both sides, and both sides affect one another. So the more, I mean, it's simpler just to observe that if there's only 10 people who have a particular card and only 3 merchants that accept that card's not going to be very viable. If you have a larger number of merchants who accept it, then more consumers are going to want to hold it because they know that they're going to be able to pay for it, use it in many different places. And likewise, if there's many people who hold a particular card, then there's merchants are generally going to want to be able to accept it because it's beneficial to them to do so. So in general, as the proportion of buyers using a card increases, so the proportion of sellers using it increases too. And this is you get this sort of virtuous circle of possession. I'll just also observe that there have been many payment card systems that have failed because they haven't been able to get that scaled adoption. Most of that happened a long time ago in the 1960s, but you see it occasionally happening today. You see it, for example, in the context of blockchain systems where adoption fails and then the system collapses. So economists refer to these situations where you have two sides of a market. You have a buyer side and a seller side as two-sided markets and where there are these sort of beneficial overlaps between those markets. They're called cross-side network effects. I'm sorry for the jargon. It's just what it is. Well, I'll try and avoid using it to the extent possible, but the point is that there's a beneficial effect from an increase in one side onto the other side. That's a cross-side network effect. So let's go on to the next slide. This sort of is a diagrammatic description of that in the context of payments, where you have this sort of virtuous cycle with a payment platform in the middle, enabling value to be created on both sides of the market. And when value is created on one side, it increases value to the other side. Let's go on to the next slide. I don't want to belabor these points too much. So generalizing again, very often in two-sided markets, nearly always actually, it's optimal for one side to subsidize the other. This starts right at the beginning, where in order to get the system going, to get to a scale where it's going to work, you have to, one side ends up paying more than the other side to get the system working. Good examples that we see around us are newspapers. Think about free newspapers. That's the clearest example, where advertisers basically subsidize content produced by the platform, the newspaper, that enabling readers to have encouraging readers to use it. Okay, so without the advertisers, the system would collapse. Search engines, basically the same. Advertisers enable the search engine to supply a high quality algorithm to the searchers, so the searchers will then use it. Both sides benefit by participating. economic theory predicts, and the evidence is clear to support this, that the less price sensitive side tends to subsidize the more price sensitive side. So in the case of newspapers, the less price sensitive side is the advertisers, same search engines, advertisers, and the more price sensitive side is the reader or the searcher. Basically, the reader or the searcher can move very easily to another alternative, whereas the advertiser is kind of tied to the system in a more concrete sense. In the case of payment systems, merchants are generally less price sensitive than consumers. Not in every case, but in most cases, they are. So you expect to see merchants pay a bit more for the system than consumers. So let's go on to the next slide. So here is a three-party network. So here's how what's called cross-site subsidies work in a three-party payment system. So a three-party payment system is like American Express or Discover, one in which the issuer, the acquirer, and the network are one entity. So there's no banks intermediating. I mean, there are of course exceptions even within the American Express and Discover networks, but in general the model is that the issuer and the acquirer is the same entity. It's also a bank, and it acts as the intermediary between customer and merchant. It charges merchants more than customers. In fact, how this works is that the customer pays the sale price and receives in return things like insurance and rewards from the acquirer, and the acquirer network issuer basically passes back to the merchant the sale price less the merchant discount rate, less an amount, which covers the cost of those subsidies that are given to the customer. So let's go on to four-party networks. The next slide. So in this case, the issuer, the acquirer, and the network are separate entities. In most cases, we can talk about on-us transactions separately if you want, but in most cases, there'll be separate entities where and in this case, it becomes much more complicated. But basically, the customer buys goods from a merchant, then pays the sale price to the issuer. The issuer of the card, so the card that's issued to the cardholder, the issuer then passes the sale price less what's called the interchange fee back to the acquirer, and the acquirer then passes back to the merchant the sales price less what's called the merchant discount rate. So here we've introduced the interchange fee. The interchange fee only exists in the context of four-party networks. It doesn't exist for three-party networks, and it acts as this balancing mechanism between the acquirer and the issuer, enabling the issuer to provide the services and the subsidies to the customer to enable them or to encourage them to participate in the network. So let's go then onto the next slide. So this then gives you a little bit more detail on why interchange fees exist and what they cover. So basically, they can cover a whole range of costs: the cost of issuing and replacing physical cards, the management and the collection costs, the network costs. So I didn't mention that, but obviously in the mid, if we go back to the slide before for a second, you can see here in the middle of this is the network, which is facilitating this transaction, actually setting the interchange fees and the rules of the system, and that charges network fees to the issuer and the acquirer, and provides services. Obviously, it provides the messaging, and it provides things like fraud detection and so on. Anyway, let's go. Sorry, on to the next slide again. The other things the network costs include investments in innovation that reduce fraud. So because the acquirer, because the issuer is in the first instance liable for fraud, they have a strong incentive to ensure that fraud is reduced. So they're willing, and we want them to pay the network to invest in things that reduce fraud costs. So things like the EMV chip, related contactless payments, all of which are in fact tokenized, tokenization of online transactions, 3D Secure, which is a system for identifying and mitigating fraud in card not present transactions, like online transactions. So all of these things are part of the network costs, which are funded in part by the issuer and in somewhat by the acquirer, depending on the relationships. Then they also fund things like rewards, so that can be cashback, airline miles, and so on. In the case of debit cards, historically, they also funded in part the account maintenance cost, although that was affected by the Durbin Amendment. Happy to go into that in more detail, but certainly in the 2000s, you saw a significant increase in the availability of free checking accounts as a result of the interchange fees being used to subsidize account maintenance, and that declined after the caps that were introduced by Senator Durbin. And just to emphasize again, three-party networks do not have interchange fees, so all of the above kind of benefits are covered in a different way in three-party cards. Okay, let's go on to the next slide. So this is a little bit about the mechanics of this and why interchange fees, or why the multilateral interchange fee exists. So as I already mentioned, so the acquiring bank receives the price paid less the interchange fee from the issuing bank. Now, so acquiring banks and issuing banks can in principle set bilateral interchange fees, and very early on, this was a common practice when there were a small number of different card networks. But as the number of a small number of different issuers, but as the number of issuers and number of acquirers increased, it became infeasible for there to be bilateral interchange fees set between all of the banks. Just basic math. If there are now something over 4,000 banks in the US, there were actually more previously. But if each of those set a bilateral interchange fee with one another, it would mean that there would be at least 8 million separate agreements. That would be a lot. I mean, can you imagine having to program your POS system to deal with 8 million different agreements? So what a primary reason why the multilateral interchange fee came into existence was to address this coordination problem. So these fees, which have been set now for decades by the networks, along with the rules associated with them. So if you have an agreement, it has to specify rules. So it specifies liability rules and all sorts of other things. These multilateral interchange fees are now set by the two main networks, so Visa and MasterCard. And they vary. And they vary by merchant, which is based in part on the location, in part on other risk factors, in part by the characteristics of the merchant in terms of the types of sales they make, the size of the sales, and so on. And the other factor that affects interchange fees is the type of card that the cardholder has. And there's sort of levels of cards, basically. And so typically cards with higher rewards have higher interchange fees. On to the last slide. Then I just wanted to make a few words about the merchant discount rate. So this is the fee that is taken off the amount received by the acquiring bank before payment is made to the merchant. And as I'm sure most of you know, there are two types of merchant discount rate. One is a blended rate. Let's say, just for argument's sake, something like 3% plus 10 cents per transaction as a flat rate charged on all transactions. I mean, these are the sorts of rates that you see being charged by gateways like Square and Stripe. And then the other type, which is the blended rate is typically used by smaller merchants. And by contrast, there's the interchange plus rate, as it's now known, is a variable rate. So it's the interchange rate plus the amount, the markup by acquirer, which might be 1% or so. So the average rate is typically slightly less than the blended rate, but for simplicity and certainty, many smaller merchants opt for the blended rate. So that's my quick overview, my 101 on interchange. And I hope it's been helpful, and I welcome questions.
All right. Thank you very much, Julian. So a little bit of an audible because of our next presenter's timeline and his schedule. So what we're going to do, if the committee members can hold their questions, and if you're okay with it, Julian, you can stick around.
Sure.
I'm going to let Bill Sheedy with Visa come and make their presentation, and then we'll open up the question to both of you folks after that presentation. Okay? Because they're somewhat similar, but I want us to get the idea of the big picture, and then we can dig into details for each committee member's indulgence. Thank you. So now we're going to hear from Bill Sheedy, Senior Advisor with Visa, and I think that is also a PowerPoint. And so that is your second presentation in your folder, committee members. And when we get ready for questions, for those folks that aren't familiar with our system, the button to the right, remember, if you have a question when we start that, you'll do it. It'll tell me you have a question, and then I'll just call on it, you know, first come, first serve type situation when we get to that point. I think most of our House members know that. Even Todd, right? Right, Noel?
Well, good morning.
He is my chairman. All right. At this time, we'll let Bill Sheedy go ahead and start his presentation.
Great. Thank you. I appreciate the time. I'm joining you from an airport, so if there's any background noise, I apologize. I had a bit of a travel snafu, so I appreciate the flexibility on the schedule, and welcome the opportunity to be with you this morning. As you may or may not know, Visa's proud to have over 1,000 professionals in our organization in Georgia. It's a very important part of the company, and as you all know, Georgia's really in a global context is a really important part of the payment system. I mean, some of the preeminent organizations that drive payments, not just locally there in Georgia, across the U.S., but globally, exist and drive in Georgia. So I think there's a lot about this conversation and you know, the role that you all play in support of the state that is important, not just to Visa, but the payments very broadly. I will say that there's a significant amount of overlap between Julian's presentation and mine that was accidental, but actually I think it'll be helpful. Too quick an introduction on me. I've been with Visa for 31 years. For the majority of my time at Visa, one of my core responsibilities was the management of interchange fees. A good portion of that responsible for that globally. Over my term with Visa, I have run the business in North America, Latin America. I was CEO of our European business and was on the executive management team, reporting to the CEO for 15 years. So, and there's interchanges at the core of how we operate the company. And as Julian already mentioned, it's a central element to how really all payment systems function. And so I'm happy to give you our perspective on it, and I'll try to keep it at a high level as Julian did. So next slide, please. So you've seen some of these in the prior presentation, but I'll try to take more of a business lens. As we think about the ecosystem and the ways in which interchange is trying to anticipate and support consumers, the merchants that consumers and merchants, they're trying to transact. They have a relationship. There's a flow there that's important to everybody, the economy, the merchant, certainly consumers, but also acquiring and issuing financial institutions and networks such as ours. You can see here at a very high level the different are played. Multiple parties that are here. Interchange isn't the only thing that happens to piece these folks together. There's technology, there's marketing, there is communication, in a world where we are operating four synchronous data centers around the world that have the capacity to move more than 1 billion transactions in a day. There's a lot that happens underneath the hood to make all of this work. Next slide, please. So when we think about the transaction flow, just starting at the most basic levels, not to keep it too simple, but I do think it's important to build the foundation. The flow of it is a consumer and a merchant introduce themselves. Sometimes those are really close, long-standing relationships. Sometimes people get off planes and land in a location they've never been and are interacting with a merchant where they don't have a relationship and there may not be trust. So the authorization, really, the communication between the cardholder, the merchant, and ultimately through the acquiring and to the issuing financial institution is essential. It ensures a payment guarantee. It in milliseconds, it helps manage risk, and I think that it really is the place where everything starts. The clearing record, which typically happens a day or two later, which is instructions to financially settle the money and move money generally from the issuing side of the business, the cardholder account, to the acquirer and to the merchant's account. That happens in a separate record, and then the settlement follows that. In some instances with debit transactions, that can be a single message. Typically in business transactions and in consumer credit transactions, those are two transactions. Next slide, please. So I don't want to redefine interchange because I think Julian did it really well. We as a network play a role in setting interchange. It's really important. This is not our revenue. So if you wonder what is Visa's interest or MasterCard's interest or other networks' interest in setting interchange fees, it's not to pull money into our organization, because it is a pass-through. The merchant acquiring side generally flows through the interchange fee, and on a net basis, it arrives to the issuer and supports the flow. So our goal in setting interchange fee is multifaceted, but we don't have an interest in setting it high or low. The goal is to try to achieve optimal sort of flow in the network, and we want consumers and merchants to come together every day. We spend quite a bit of time talking with the merchant community and their concerns around their costs, their operations, and that's a really important dialogue and important perspective. What often gets lost in this is the consumer perspective, and cardholders have, most of whom can't spell interchange, don't know what it is, but they have a very strong interest in making sure that their products work, that the financial institutions and the networks are investing in systems and products and communications and marketing to support consumers. And what cardholders don't understand is that interchange, in many ways, in particular for a transactor, is the primary, if not exclusive, revenue stream to an issuer for them to support those transactions. So it's essential in keeping this together. We don't set the merchant discount rate. That's set by the acquirer. There are thousands of financial institutions on the acquiring side who sign up merchants to accept payment cards. What's also really important, Julian mentioned this, in the United States, there are thousands of financial institutions, issuers, who receive interchange every day, every second. And these range from local community banks and credit unions all the way up through the largest issuers who have some of the most highly visible co-brand programs and other products. And we as consumers, we benefit from that. We have the benefit of going to our local credit union, or community banking, getting a product that has the same functionality, the same power to transact anywhere across the global network. Likewise, merchants have the power and the benefit of turning to any number of hundreds, if not thousands, of acquirers who can price their business and set their merchant discount rate. As Julian mentioned, this flow works a bit differently in three-party systems like American Express, where Amex serves as both the issuer, the network, and very often the acquirer. So the terminology is different, but I would say that sort of the general flow of what we're looking at is not different. Next slide, please. So again, balancing the two-sided market is really at the core of what we try to accomplish with interchange fees. We don't necessarily think about interchange fees as covering costs, because it's more than that. It's, what is American Express doing with its products, and how are we positioning our premium products against American Express corporate card, small business card, our premium products. Likewise, when you've got emergence of new technologies, whether those digital wallets, chip a number of years ago, all of these things get factored into interchange, along with fraud and authorization expenses and the cost to underwrite accounts, both on the merchant side and on the cardholder side. And it don't mean to make it sound massively confusing, but it is a whole host of things that get thrown into that funnel, where a network sits down and thinking about the consumer, the benefits and their demand, and the merchant benefits and their demand for payment products, and try to achieve as best we can a balancing act that would blend all of that together inside a broader strategy. But as Julian mentioned, you're setting interchange rates differently by type of payment product, by merchant segment, and down to how is a transaction processed? Was it authorized? Did we include all of the cryptograms and other things that help us manage cyber and fraud? Was it processed in a timely manner? All of these things can factor and would influence the level of interchange on a particular transaction. Next slide, please. So I really have hit all of these points. Don't think about it as just a cost flow. It's the strength and the integrity of the system. We understand interchange is a cost to the merchant community. That's certainly a lens. We don't want that number to be too high, because obviously merchants would then have an interest in preferring other forms of payment. We do want the cardholder side, which is on the left-hand side, be really visible and important. And again, I think the consumer impacts and the consumer benefits from interchange very often get lost in this conversation. And at the bottom part of this schematic, it says incentivize technology improvements. There is, from a distance, a misperception that the payments are a rather simple thing, and it's just a flow of authorization messages and a flow of money. Behind the scenes, as we all know, there is massive amounts of risk in the system, lots of complexities. The integration of digital wallets into all forms of computing and mobile devices have been enhanced greatly based on innovations that we have pioneered, tokenization, which we can talk about, but also a whole host of things that we key off of to help manage risk and improve everyone's confidence in the payment system, which benefits merchants and cardholders. We don't need them to think about it, but it is essential, and it all gets factored into how we set interchange. Last slide, please. Yeah, this just gives you a rundown between how it works in Amex, a three-party system who doesn't have interchange because they don't typically market their products through banks. They distribute them directly. The long story short with this slide is it works very similar in Amex. The terminology is different, but they are a head-on competitor for us, particularly in small business, corporate, and in upscale consumer credit. Next slide. I guess that's the last point I want to make, is that we often talk about interchange just strictly in the context of card payment transactions. And I, again, spent a lot of time with the merchant community who was concerned about costs. I would respectfully point out that all forms of payment have costs, and all forms of payment have different benefits to consumers and to merchants. And so there can be an argument made sometimes that other forms of payment like cash It's a shrinking number, but still significant. People writing checks. These have costs associated with them. They have friction associated with them. They provide different levels of value to both consumers and to merchants and the broader payment system. Frankly, I would also argue the economy. And so as we think about the costs associated with interchange and the electronic payment system, I'd also try to remind us that by reducing friction and improving the efficiency and the flow of the economy, which is primarily driven by consumers and merchants coming together, the interchange model creates a very efficient and very effective payment system, and it's been there for decades. It's always evolving, but if we think about it in the context of other forms of payment that offer less value and are creating more friction and very often more risk to the payment system, I think that's an important point of reference rather than just putting on our blinders and only looking at Visa, MasterCard, or Amex, because really this is an economic topic and really all forms of payment and any instances where consumers and merchants come together, you should think about the electronic payment networks as competing and trying to innovate and try to improve ourselves in that context. And interchange is essential to that dynamic. So that concludes my prepared remarks, but I appreciate your time.
Okay, thank you very much. So committee members and audience and guests, what we're going to do now is, because of his time constraint, we're going to first, for committee members, if you've got a question for Bill Sheedy, for those here in the room, just press your button, you'll be in the queue. If you're online on Zoom, just raise your hand, and if you want to type in your question, David will see that, and we'll go from there. And then Julian, if you're still on, we're going to come to you second if that still works for your schedule. So committee members, if you have a question for Bill Sheedy with Visa, now is your time. Okay. 17.
Hi, Mr. Sheedy. Kevin Carroll with Racetrack. One, thank you for the presentation, and having been on all sides of this, from banks, networks, merchants, complete agreement in the fact that interchange is required, and other forms of payment, my opinion, in particular cash, costs more than use of a card by consumers. What I'd like to jump in on for a moment is, and hopefully you have the level of detail on it, is one of the things we're talking about here is not eliminating interchange, but applying interchange to tax, where merchants have to remit tax to the state, and tax is still, interchange is still applied to that tax amount. So for argument's sake, it's a $100 purchase, tax is 9%. Merchant is paying, for argument's sake, 3% on $109. I want to drill into the difficulty of pulling out that tax data within a message, because today the tax information, I don't believe, is passed to the issuer in any way, shape, or form. How difficult is it to separate tax information, and does it happen today for some cards?
Yeah. Hi, Kevin. I appreciate the question. It's very clear. I'll get to the last part first, which is going back probably 20 years or so ago, we realized that on certain commercial products, small business products, it was of value to capture what we refer to as level 2 data, which the core of which is some tax information in the transaction record. And it's a good example of how we used interchange. We created lower interchange as an incentive for that information to be appended to the clearing record. And I'd say that over time, that was modestly successful. And one of the benefits of the system was that you had large corporations who had complex relationships with their vendors, and they put pressure on those vendors to say, look, I need this information for my tax filings for my business. I need you to pass this information on. Sometimes it would come through real time or in the clearing record, which is a day or two later. Sometimes it would come later in a separate file that we would figure out a way to attach to to the account. It was hard. And I'd say that within the narrow band of business to business transactions, made
You're
a
freezing up
decent
on us.
amount of profit. That wouldn't have happened without large corporates in particular putting pressure on their vendors and even getting to the point where they're negotiating their contracts. They were requiring that information to come through. The second thing, and maybe more important to the question, is almost always that information came later. It wasn't there present at the time of the authorization. And it was because it was too hard for the point of sale. It was, remember, when we're processing a transaction, Kevin, you know this, but I'll point it out for everyone else. We don't know what's in the shopping basket. We know the total of the transaction amount. And you think about a grocery transaction where you've got some transactions that are tax exempt, some transactions that are taxed at different levels, because you get different goods in the basket. At the moment, at the time of authorization, that is completely unknown to us. And so building a system whereby all of that information could not only be can be captured in the authorization record, but then factored into the application of interchange, which starts with the indicators that we see in the authorization record. When a transaction comes 2 days later, a day or two later, and we're applying the interchange, we're referring back to the components of the transaction that were in the authorization record. So at the moment, I will tell you that across the more than 10 million points of sale that we have in the United States, there is almost no availability, no capability at the moment to capture that information at the time of the authorization. Then we have the separate question of, okay, if we were to capture it, how valid do we know that it is? And I think the answer is it would require a lot of work. And then I would ask, okay, so if we can apply interchange on a net amount, a gross amount, from a Visa standpoint, like when the transaction's coming through and you're asking, all right, so what are we multiplying by what in order to calculate the interchange? The complication isn't on our side. It's across the thousands of banks who are supporting the merchants and the terminal manufacturers and the processors. We're happy to work and see like what could be done, but as we've studied it and we've talked to the companies that make the terminals at the point of sale, it would require a significant effort, and it's not clear in some transaction types how it would work. And then I would ask, sort of, not to be difficult, but I would ask sort of to what benefit, like to what end? And because if you take an interchange, which I'm just going to use a round number, 2%, and you multiply it times a transaction amount that is without tax, or you multiply it times a transaction amount that has tax, I mean, I can get to the same level of interchange irrespective of whether or not I multiply it times a number that is net of tax or gross of tax. And so, I think the point that we tried to make in the presentation is we set the interchange in order to create an economic flow so that, in particular, issuers are investing in consumers who ultimately drive the demand and have the partnership with the merchant community. We still would need to sit back and say, okay, well, what's the right level of interchange that needs to flow to that side of the business in order to make all of this goodness happen? And if we ended up netting it out of, if tax ended up being netted out of the transaction amount, I'm not sure that we would necessarily alter the level of interchange. We would just multiply a slightly different number times the net versus, a lower percentage times the gross. So I think you would end up having a lot of work across the many participants in the payment system and the technology infrastructure. And with all due respect, I'm not sure I see the benefit.
Please.
I'm going to go to another question. Thank you for the question. Thank you for the answer. Number 13, I believe that is Joe Rowland.
It is. And I can't remember if it was Bill or Julian that spoke about this, but you mentioned that the interchange fee goes in part to mitigating fraud and fraud detection. Are either of you able to go into that a little bit more? Exactly what happens?
Yeah, I'm happy to. So, part of there are costs at both the network level, which when we incur costs, we charge fees to the banks who sign up to run transactions over our network and to license our technology. So we make investments in for real-time fraud screening, increasingly artificial intelligence, but historically a lot of it was just like really smart, looking at fraud patterns, historical fraud patterns, and sort of investing over $1 billion a year in a whole host of things within the Visa system to manage fraud. On the issuing side, the cardholder side, remember they're sitting here. They've got an unsecured credit line. If we're talking about a credit card, and the consumer's trying to access that. Almost always, they're doing it for valid reasons. But if the communication's electronic, the issuer doesn't know whether or not that transaction is absolutely valid or it's got underlying fraud patterns. So the issuers are also investing across the system billions and billions of dollars so that when they authorize a transaction, that they're giving they're declining the transactions that are bad, that are fraudulent, and they're approving the transactions that are valid. So there's massive amounts of cost there. And interchange helps motivate the issuers to make those investments, because if you're talking about a consumer who's just transacting with their card, generally speaking, in the United States, there's no other revenue stream to help compensate them for those costs. The last thing I'll say is if you have a clean authorization, so you get a full chip read, you have a transaction that is authorized appropriately at the point of sale, that transaction's guaranteed to the merchant, to the acquirer. So that payment guarantee is an expense to the issuer, in addition to the investments that they're making. If that transaction ultimately ends up being fraudulent, the issuer eats that cost. And so interchange is in part meant to help defray those costs.
Bill, I want to make sure I understand that correctly. So when you say the issuer of the card, that means the issuing bank, not Visa, correct? Eats that fraud cost, typically.
That's correct. I apologize for the shorthand. We're a network. We don't issue cards. We license a brand. And when I talk about issuers of the card, that's the cardholder bank.
Thank you. We've got one more question for you. I know you've got 11:30, so I'm going to turn it over to Representative Todd Jones for his question.
He has an 11:30 flight.
11:30.
Oh, okay. Well, then
no, for what it's worth, I'm boarding now, but I because of the travel problem I had this morning, I told them that I'd be happy to board late.
Okay. I have way too many questions to fit in. Several statements have been made that are concerning to me, Mr. Chairman. But let me just go right to the root cause, like one of my co-committee members talked about. If you looked at the Visa four-party model, the one that you have on your last slide, slide 7. So that's merchant, acquiring bank, Visa, issuing bank, cardholder. I'm going to go ahead and add in another box, the government, the state government. If we're just talking about the tax portion of a sale, is it fair to say that the merchant has absolutely no upside? In other words, that interchange, all the fees that are charged on that 7%, everyone in the four-party model, other than the merchant and the cardholder, are making money off of that. And the government, if we add in that box, is making money off of that. But the merchant makes nothing. Matter of fact, the merchant holds all the risk. Is that a fair statement? Or nearly all the risk?
I don't agree with the idea that the merchant holds nearly all the risk. I mean, there are instances where a merchant is let's assume we're dealing with an e-commerce merchant, for example, and
Sure.
they're shipping goods, and there's definitely instances where, you know, because they shipped goods, they might be out, and there's definitely risk that the merchants have to concern themselves with. I will tell you that that zeroing in on subsets of the merchant's costs, whether it's the cost to pave the parking lot, or operate a storefront, or to manage an e-commerce site, and I would argue that the costs that they pay for services provided by the state of Georgia and the taxes that merchant pays, we all pay taxes. It's really difficult, if not impossible, to isolate in on one component of a merchant's costs and say, well, wait a minute, that doesn't really benefit the consumer. That doesn't. Why is it that people are benefiting in the flow of a transaction record? I see the point that, and I can't argue, interchange is multiplied times the gross transaction amount. That's just the way that the system works and how we've loaded the transaction. But I'm not sure I can necessarily break down all of the merchant's costs and say, okay, well, these are the costs that would be appropriate to multiply an interchange fee times, and then these are the costs that really interchange isn't relevant, and so we should pull those out of the equation. The answer, at least for me, is we're trying to deliver to the consumer through their issuing financial institution enough of an economic flow so that all of the investments can be made in a way that is good for the merchant, good for the cardholder, and I would argue good for the state of Georgia. And if you start bifurcating, and I really do have a difficult time with the conclusion that, well, we'll just multiply the interchange percentage times a different amount net of taxes, it doesn't change the fact that our objective is to make sure that the consumer is being invested in, and that the cardholder side of the payment system, the four-party model, is working. And I would tell you that if the state of Georgia asks us to multiply the interchange by a different amount, we're still going to try to deliver enough interchange back. I don't know that it necessarily does anything, in my view, other than create a much more difficult transaction flow and a lot of expense and a lot of friction in the course of the transaction.
Mr. Sheedy, your comments to me and another committee member are concerning because of the fact that you sit as part of one part of an oligopoly. You do have that power to be able to, as you've now stated 2 times to the committee, you can just quote, change your fees and basically change the rate that you're going to charge against, I'll say, the amount of the sale versus the tax, and effectively create the exact same net revenue. So in many ways, you're supporting the idea that given the market share that you and MasterCard hold, and by the way, God bless you. Every person in this room's 401k is better since you guys have gone public, and it might be the only thing that happened in 2008 from the financial markets. That's a good thing, because a lot of us think back to 2008 in a pretty bad way, but you guys going public, you've been very, very successful, and kudos to that. But it also talks to the strength based on your answers in terms of the market pressure that you have and your ability to affect pricing that, frankly, the merchants, the cardholders, the taxpayers, the state of Georgia, none of them hold that level of power that Visa holds, and MasterCard for that matter. Mr. Chairman, I have literally a series of other questions, but I understand that he needs to get to an airplane. I want to be respectful of that. If it's okay, I'd like to reserve the right to maybe ask him questions via email and hopefully get those answers. Would that be okay?
That would be fine. And if you wouldn't mind just sharing with the chairman the questions you're going to ask, I'm definitely amenable to that. I'm sure, Bill, you're amenable to that as well.
I am amenable to that. I'm also, I would have preferred to be there in person, and certainly to take more time. I'm happy to re-engage with this committee in your important work at whatever time, whether we do it offline with emails, or if you'd like me to spend some time with the committee again, I'm happy to do so.
Well, this is a first of at least 1, maybe 2 more meetings, so we will definitely get back with you on that. Are there any other questions for Mr. Bill Sheedy? Okay, I don't see any flying up. any questions for Julian? I appreciate you waiting. All right. I don't see any folks. Did you have any questions, Todd, for the professor? Okay, so we do have a question. No, that's fine. So, Bill, if you need to go ahead and get on, you have a blessed day.
Thank-
All right.
Thanks so
you.
much. Appreciate it. Bye.
All right. So, David, will you get Julian back on? And okay, here we are. All right. Julian, Representative Todd Jones has a question for you.
Sure, thank you.
And my apologies, sir. I don't know if you hold a PhD or not, and so I'll just call you Mr. Morris instead of Dr. Morris.
I don't, so that's fine.
But if I could ask you, you made a comment when you were referring to the slide that says, why do interchange fees exist and what do they cover? Couple of things I'd like to ask, if you don't mind. Do you have a same time commitment as the other gentleman?
No, I'm fine.
Okay, thank you.
As long as you like.
Generally speaking, in the last 5 years, has processing volume gone up?
I believe it has, yes.
Yeah. Do you have an idea about how much it's gone up?
No, I don't have the statistics right in front of me. I'm sorry.
Do you think COVID had an impact on the amount of card sales versus cash sales in the United States?
It did. I mean, certainly there's been a general trend. I mean, over the course of the past 20 years, there's been a significant shift away from both cash and checks and towards using card payments. I mean, that's very evident in all of the data. And COVID it went up a lot and then it fell a bit afterwards as people shifted back. But the general trend is certainly towards using card payments, which seems to be generally beneficial to all parties. I mean, I'll give you. So unfortunately, it's not yet been published, but I've a paper that will be out in the next few days on looking at the cost of payments, and that paper makes I think a fairly good case that the overall cost of card payments is lower than for other forms. So that shift is a good thing. I think we'd agree.
Sir, I'm not going to argue, and I agree with you. I think the free flow of capital is a good thing, and anything that we can do to help Georgians be able to transact capital and merchants to be able to accept money is absolutely a good thing. But the question has to start to become, inside of the value chain, if any part of that value chain starts to have more power than the other parts of the value chain, do you have to question that value chain? Now, granted, Mr. Chairman, I understand that this subcommittee or this committee was only created for the purpose of analyzing the interchange on tax, but the speakers have come here today, not just talking about the interchange on tax, but talking broadly about the industry. If it's okay with you, sir, I'd like to broadly ask those questions. Okay, thank you, Mr. Chairman. You made a statement during that same slide where you said the issuer is liable for all fraud. I found that a little surprising given the fact that the data that I have been able to pick up from a series of different documents would indicate to me that the merchant actually has about 65% of the time, give or take 5 points, picks up, in a sense, the cost of that fraud. Was that a misstatement on your part, or did I not research this correctly? As I explained, I have COVID. I may have misspoken, but I believe that what I said was that in the first instance, the issuer is liable, and so that's. And then they take on that responsibility contractually to the cardholder in the form of this zero liability agreement, which is actually part of the framework that's set in both by Visa and MasterCard. And then the question is whether the transaction has been appropriately authorized. And if it's been appropriately authorized, that will be the end of it, and the issuer will remain liable. If there's a question about the appropriateness of the authorization, then a chargeback might be initiated against the merchant for failing properly to authorize a transaction. So I'll give you an example though. Over the course of the past decade, there's been a significant reduction in card present fraud, and the reason for that is that there was a change in the liability rules where the merchant is concerned. So where a merchant has adopted and uses the EMV chip or contactless transaction method, they are able to avail of a much lower liability level. And then the question is whether the transaction has been appropriately authorized. And if it's been appropriately authorized, that will be the end of it, and the issuer will remain liable. So there are
as compared with if they use a swipe. The reason for that is that swiping cards, swiped cards, the mag stripe, are much easier. They could be much more easily copied and a copy used for a fraudulent transaction. So the shift that's been incentivized by the networks through to the merchants via issuers to adopt the chip-based system has dramatically reduced fraud, benefiting the system overall. So that the liability system seems to work quite well in that regard.
Yes,
All
sir.
right.
I mean, there's no doubt. Oh, I'm sorry, Mr. Chairman.
Just one moment, Todd. I've got another person in the question. We'll come back to you, but I want to make this statement for the committee. At our next meeting, and committee members, feel free, if you have information regarding the connection of fraud as it relates to to interchange and to swipe fees, I'm all ears to hear presentations for both the merchant side of what their fraud concerns are, as well as the issuing banks. So just FYI, that will be a topic of more detail at a future meeting. But I'm going to go to one question because he's been waiting, and then I'll come back to you, Todd. Dr. Joe, go ahead.
Thank you. Julian, I'm seeing this more and more. I've seen it more in the Midwest where I'm from, and now down here, it seems to be restaurants primarily. If you go into a place and they are charging you a 3-4% surcharge to use a card, do you know where does that go straight to the merchant? Does any of that pass through to either the Visa MasterCard network or the acquirer or the issuer?
So my understanding is that if a merchant is requiring a surcharge, that's going directly to the merchant. I guess if they're charging that additional amount on the card, then interchange will be charged on it in the process. So there'll be ironically an increase in the revenue there, both to the acquirer and to the issuer in that amount. But the main cost comes to the person who's being charged that extra amount. Yeah.
Thank you. All right, Representative Jones.
Yeah, sir, I'll make this quick. I have so many questions, but in terms of the fraud itself, is it fair to say that inside of each fee, inside of the interchange fee for each transaction, is it fair to say that there is already, I'm going to call it fraud costs baked into that? In other words, almost like an insurance payment, almost prepayment on fraud on every transaction.
So one of the reasons why interchange fees vary from merchant to
I understand,
merchant
sir, between signature debit, PIN debit. Yes, sir. Aware of that.
Is to take account of the risk that merchant faces. Yeah. So I mean, I think presumably you're correct that there is some element of that. Obviously, the proportion that's charged for fraud won't be actually directly proportional to the explicit likelihood of a fraud for that particular merchant or that particular card. It's sort of an average amount, right? So
Correct.
You're not really.
But sir, effectively, an insurance pool is being created. No different than, and again, I don't want to get into this, and Mr. Chairman, I apologize, but you know, when one of our favorite Georgia companies, Delta, takes your ticket price for next March, we all know that there's a certain amount of deposits that are kept, reserves that are kept, etc. Not everything moves over on that March ticket. So I understand that. I was just asking, was there a pool? And it seems like there is.
I mean, actually, the answer is no, because it's not as though that amount is somehow sequestered by the issuing bank, put into an.
I was just giving that as a metaphor,
not an insurance
sir.
pool. It's simply a part of that whole fee structure.
Yes, sir. Okay. The last comment or the last question that I have, actually I have more than this, but for the purposes of time, Mr. Chairman, in terms of the United States versus the rest of the industrialized world, where would you rank our fees overall? In other words, against the EU, against China?
So
Japan,
many other countries
Korea.
around the world have imposed caps on interchange fees.
Yes, they have.
And the effects of that have been to distort the markets. I've written numerous papers on this, which I'd be happy to share with you. I mean, for example, Australia imposed a cap in 2002, which came into effect in 2003. And the immediate consequence of that was to distort the market actually in favor of three-party networks. So there was a 25% increase in the market share of Amex, which had higher merchant discount rates than the rates that were being charged by acquirers for the four-party networks. And at the same time, this benefited mainly those three-party networks and their primary constituents, who are wealthier people, as against poorer people who lost out massively in terms of reduced benefits from their cards. You saw a reduction in, like, I mean, so among the other things that exist on cards are insurance for payments, insurance for cars that you hire, and so on. Those benefits were significantly reduced in Australia. They were likewise dramatically reduced in the EU. But it's not clear that the overall benefits have accrued to merchants in any of these places. There's been a small benefit to some merchants, probably the larger merchants out there, but smaller merchants have rarely seen a significant reduction in the charges that they face in terms of the merchant discount rate. So I'd be very wary of looking simply at interchange fees in different parts of the world and inferring that somehow this is a good measure of the costs that merchants face, or rather the net costs, right? So because it's clear that, for example, in Australia, there was an intention to shift from certain types of payment to certain other types of payment. The intention was to shift towards the local FPOS transaction system. The same in Europe, the intention was to try and shift towards the domestic card schemes. But that doesn't necessarily benefit either merchants or consumers, especially if it results in a shift away from using card payments and towards cash, which is more costly, or to using checks. Now, obviously, these different payment systems in different parts of the world are also difficult to compare exactly with the US. But is that, I mean, I'm not quite sure where you're going with this. I mean, you stated earlier that there's an oligopoly and that Visa and MasterCard have enormous power. Actually, as I understand it, they're in quite intense competition both with one another and with the three-party networks. And their main focus is in trying to balance the system, in trying to manage the benefits overall for all participants. And if one part of the system is distorted by governments imposing price controls, then they'll adjust by shifting the prices that people are charged. That's their responsibility to their consumers. The consumers of Visa and MasterCard are the banks, not us, right? So their responsibility is to make sure that the banks are able to charge the right prices to balance the system for the participants, the merchants and the consumers.
Okay, I've got one more question.
Can I?
Yeah, one more follow-up if you don't mind, and then I'm going to go to the next questioner.
It's not a question, it's just
Sure.
I'd like to answer his question now.
Okay.
First, my query regarding the United States versus the rest of this in the industrialized world wasn't about anything other than trying to just get color in terms of what, from a global market standpoint, what our merchants are, I'll say, dealing with. By no means do I want us to have any type of price controls. I don't believe in that. I believe in the free market. Speaking of the free market, it is an oligopoly. It's literally something that if you go into Eco 101, this is without a doubt the 100% definition of an oligopoly. And look, I'm not here to criticize that or anything, but I'm just stating a fact, given the price power that they have. And then last, in terms of, you mentioned that you would send us some research. I would appreciate it if you could send that research to the chairman so he could distribute it to the committee, please.
I'll be delighted to, yeah.
Okay,
Sure.
thank you so much.
Thank you very much. And 17, is that Kevin?
Yes, sir. Thank you, Mr. Chairman. Mr. Morris, thank you. And I want to jump to the point in your presentation you made and Mr. Sheedy made as well around the importance of interchange and how it helps fund and create consumer programs. insurance on purchases, rewards programs, things like that. In particular on credit cards, which is where most of the rewards programs exist. Another piece revenue that banks get is interest on outstanding balances. Average 24-25% on most credit cards. And as you had stated in your presentation, the more or the higher value of rewards, consumer card, platinum, black, purple, as my Delta card is, whatever it is, the more rewards there are, the higher the interchange there is for those cards. But isn't it also true that conversely, even though higher interchange is being paid for more rewards, most interest is paid by consumers of lower income, and they're paying the 24-25% interest rates on their outstanding balances when the higher reward cards are traditionally paid off at the end of the month or rather quickly. So banks are drawing huge amounts of income off of interest rates for lower income consumers, and that's a large piece that helps fund the higher end rewards. Is that a fair statement?
So I'm not entirely familiar with the internal mechanics of payments regarding the differences of income from interest versus interchange. But when we're looking at interchange, alone, it is priced in order to cover, in principle, those higher level rewards. But yes, I suppose it's possible that some of those rewards are covered by interest. And it's true that the data suggests that when it comes to revolvers, so heavy revolvers especially, there do seem to be a larger proportion of those people who have lower credit scores and or on lower incomes. So I think this is a very different matter. I will have to look in more detail at the numbers to understand whether, in fact, that's the driving force behind payment for or even part of the payment for rewards. But it's certainly it's not clear that that's the case. Prima facie.
Thank you very much. Appreciate it.
And I'll just I'll put on my banker hat if you don't mind, since I've been doing it since 1998. I understand kind of where you're going. It's not really direct purview. It is interrelated. So I appreciate the question. I would also say that typically when there's a greater risk, there's a higher interest rate in any type of credit facility, because the percentage of charge off, which is a direct cost, shareholders have to be protected. So it'd be like me going into a gas station and, saying, hey, what's your markup on your Doritos, right? When I can go to somewhere else and buy at Costco. It's all about convenience, and everybody's got a different price point. I have an 8-year-old son that consumes Doritos far more than I would like. But anyway, I appreciate the question, and great discussion. And now we're going to, has anybody got any other questions for Julian? I do appreciate your presentation. I do wish you well in your recovery. I know you've been struggling, and appreciate you being here. And I look forward to seeing your report, and I will share with the committee members. Hopefully we'll have that sometime in the next few days or next week or so. Thank you very much. At this time, I'm going to ask the committee members, do y'all need a 5-minute stretch? All right, we're going to do a 5-minute break, and then we're going to have some folks from the Department of Revenue come and make their presentation. So let's get back in here at 5 till noon. Thank you. What's that? That's a great discussion. All right, we got our 30-second warning. If everybody will come back to their seats. I know. All right, I know. I'm standing between you and lunch. I understand. And we all have our next favorite presenters, Department of Revenue. I mean, who is stoked? I'm stoked. I'm excited. I appreciate them. And in all seriousness, for the guests here today, committee members, I want to thank Department of Revenue staff because before we were able to I had sent out some requests for folks to be a part of this initial meeting to be more informative about the ecosystem of interchange. They actually first completed their presentation and included it as a unbiased opinion. And so much of their presentation has been covered, and we will not belabor it for the committee members and also for them. But I do want to thank them and their staff for being willing to take a good old college try at it, and they did a good job. And for me, as a Dawsonville guy, I was like, I could teach this as a high school class. This is a perfect presentation of what interchange is. So I think y'all did a great job. And for the average person, I think they deserve a good pat on the back. So with that, are all our committee members back? I think so. All right, I'm going to turn it over to Kelsey, and I'll let you introduce your coworker, and we'll go from there.
Hey, I'm Kelsey Finn. I'm Director of Tax Policy, and this is Chester Cook, our Deputy State Revenue Commissioner. So we're actually going to start on slide 9. All right. And hopefully we can fill in the government portion of that chart earlier. One more slide. So currently there are 2 components to a transaction. The first component is when the customer purchases the item, and the second component is when the sales tax is added to the transaction. An interchange fee is charged to each component. So in our example, the customer purchased an item for $100, and their either in is a 7% sales tax. So the merchant then charges the customer $107 for the sale of the product. Component 1 is the merchant pays the interchange fee, and then the retailer collects the discounted value. So this in this transaction, it would be $2.20. And then the second component, the merchant pays an additional interchange fee on the 7% sales tax, so on the $7. So at the end of the transaction, the merchant paid an additional 14 cents due to the sales tax interchange fee. So go to the next slide. Vendor's compensation. So this is the answer to the interchange fee on the sales tax currently. Most vendors file monthly returns, even if no sales tax is due. Vendors are allowed to keep a percentage of the tax collected. This is known as vendor's compensation. In Georgia, the deduction consists of 3% of the first $3,000 collected and 0.5% of any amount collected over $3,000. So for example, if you collected $5,000 in taxes, your deduction would be $100. That's $90 for the first $3,000 and $10 for the next $2,000. The vendor's compensation can only be taken for returns that are filed and paid on time. Another term for this is a prompt payment rebate. You can go to the next slide. So vendor's compensation in other states. We chose a variety of states that are around us or similar in size. Alabama is 5% of the first 100, 2% over 100, and they do have a cap. It's $400 per month. Florida is 2.5% on the first 1,200, and it's a max of $30 per filing fee period. We're 3,000 on the first 3,000 and 0.5 on anything above the 3,000, and we are an uncapped state. Louisiana is 0.84% of sales and use tax, and they do have a cap of $1,500 per month. North Carolina does not have vendor's compensation. Pennsylvania and Virginia are at 1%, and they're capped at $25 per monthly filer, $75 per quarterly, and $150 per semi-annual filer. And Tennessee is 2% of state tax due, and their cap is $25.
Just a quick question, $25 per transaction or,
Total for the return.
okay, all right.
So we
thank
talk about the caps, which are usually monthly. We're talking about what they cap the vendor's compensation
Okay.
at within that.
Okay.
Okay, next slide. A little bit of this has already been covered. Obviously related to fraud with all the private sector data breaches, the cost of fraud, which I think as we heard is generally borne by the issuing bank. And then of course you have chargebacks as well, that go in there. And generally as it relates to fraud, if it's the issuing bank that, if they're the ones eating it, they typically wouldn't have a recourse in terms of what was the sales tax piece that was financed by that, because the merchant may have received the whole amount. If a retailer were to have not necessarily fraud, but a bad debt, let's say they had a relationship related to this or otherwise where they were carrying the receivable itself and the receivable went bad, then we do have a bad debt deduction that's available for those, but that wouldn't apply to fraud because it's not a receivable to begin with, and it'd have to be carried by the merchant who could take a deduction on their sales tax return.
Any questions? I've got a couple, but I'm going to let the committee members. Anybody have any questions? All right.
I'm going to ask one simple question on the fraud issue. So who eats the fraud? Who is it? The bank and the merchant? Are they the ones
For
that?
the credit card, I think it's typically the bank, issuing bank.
Okay. So the merchant is clear.
Well, I'll ask it this way. In the Department of Revenue's opinion, when there is a merchant and the merchant eats a fraud, what is typically what you guys are seeing when they're filing their returns that you guys are monitoring for that situation?
Yeah, we don't, in terms of what ends up on the return, we don't see a lot. We would see it if there was a bad debt deductions, and just from a experience basis in terms of what we see on audits, not a lot there. If it's something where there, fraud, which would be something like theft, they wouldn't be subject to the sales tax at all if it was a theft of goods.
Okay.
But for the fraud itself, that would be between the retailer and the issuing bank. I suppose if there were some liability for the retailer, something might end up there. But typically we don't see it other than the bad debt deductions. And
Okay.
the vendor's
All right.
not going through the return.
We've got two more questions. First, Kevin Carroll.
Actually, your question covered mine, so we are good. Thank you.
We've got Joe Rulin.
Hi, Joe Rulin. I've not seen a Georgia sales tax return. So when those are filed, is there a delineation between different tax rates that might apply, whether it be excise taxes, or maybe this doesn't fall within your purview? I'm not sure. But do you get to see the different rates that are being paid on different levels of sales, or is it just one?
Sure.
number?
So the way it works is the way the sales tax return works, and this was discussed a little bit earlier by some of the presenters, is you can have rate differentials. A common example of that would be the food exemption, where picking your grocery items that aren't prepared foods would be exempt from state sales and use tax, but still subject to local. So we do have rate codes for rate differentials. There are some others for manufacturing, other things typically wouldn't ever occur in the context of a credit card situation because those are B2B transactions. But it is broken down by the tax rate itself. So if it was tax on groceries, or say reporting local sales tax on motor fuel, that is differentiated on the sales tax return. The tax itself is aggregated, and then the vendor's compensation is calculated there. There's a slight difference for motor fuel, but for what we're talking about, bread and butter retail type situations, it's the 3% first, 3,000, and then 0.5% over that. But that's aggregated together, and then they determine the vendor's comp. And it's not just the state that's part of the vendor's compensation, because we collect state and local tax. The vendor's compensation comes out of both, but it is broken down. And whether it's it would be state only if it was, say, a hotel motel type return, state only if it was a motor fuel return, in terms of who pays the vendor's compensation. And then if someone has multiple locations, the vendor's compensation for those that file on sort of a consolidated basis, is still 3% per 3,000, 0.5% on a location basis. So it isn't if they had, 30 stores and rolled up that then they run into the cap. It's on a location or sales tax registration basis because they would have one for each location. Thank you, sir.
All right, we got another question here from Kevin.
Hi, thank you. So looking at your calculations to make sure I'm doing the math correctly. Listing the 7% sales tax, interchange on that comes out to the 14 cents. With the cap of 1,500 per month, roughly the break even is 11,000 transactions, caps out at the $1,500. Any merchant that does above that 11,000 transactions a month in aggregate, it's then just complete out the door. It's not covered by the 1,500.
Yeah, we were just putting a general example in there.
Exactly.
We didn't
The
get
numbers,
into,
the numbers
do
will
the numbers
vary.
go up? Is there
Yes.
differentials between retailer size? We were just
No,
trying
just
to
trying
one
to
that.
make sure I understand the break even. 1,500 covers X amount of transactions in your example. If it's 13 cents, it's different. If it's 25 cents, it's different. Just want to make sure I understand the math correctly.
And in Georgia, there are no caps.
On vendors' compensation, that is
Yep.
correct.
Okay. All right. That's good information to know. All right. Any other questions? I've got a couple, but just want to clarify. And not to correct the Department of Revenue, but I want to clarify something. At the end, that 14 cents is paid by the merchant, but it's effectively paid by the consumer. Is that a fair statement? I mean, I know unless you're a nonprofit, you're embedded that cost into the overall cost of goods sold. Part of the charge of this committee is to look at the impact on both business and the consumer. And if I am being charged a fee to my credit card and that 14 cents is being remitted related to the interchange fee for the collection of those taxes, that's coming out of my account, right? I mean, it's technically going to be coming out of the total transaction, and most for-profit businesses understand what those costs are, and it's embedded in their price structure somewhere. I.e., what I'm seeing as a consumer, especially in restaurants, and actually at 2 gas stations in my community, I get a cash price and I get a card price, and those are different based on the impact of interchange. So that's just the experience that I've got. Obviously, that's in a micro level, anecdotal, but I'm seeing that more and more, especially at restaurants, particularly. But anyway, another question that I have, in a fraud situation in which a bank is involved and they are the issuance of that card, and there has been a fraudulent transaction for a merchant. The merchant did what they were supposed to do. They sold that product or good. They received their portion of the net after the interchange. The sales taxes that are collected on that have been remitted to the state. In a situation where the issuing bank 1-2 weeks later finds out there was a fraud transaction, does the Department of Revenue have a mechanism to reimburse the bank the sales tax portion that was paid on a fraudulent transaction?
Yeah, we do not. The retailer, if they had a bad debt, could take it. The person financing the transaction is one step removed.
Okay.
So we have some, in terms of how that works, some case law on that as well that has happened in Georgia in the past.
But right now, the bank that's had that hit does not get reimbursed for the sales tax portion that's been collected by the state.
Yeah.
Correct? Okay. Just making sure I understand that. And then, do you know what the total dollar amount in 2023 in vendor comp was?
Yes, it was $170,871,627.
Okay. All right. If we can get that exact number sent to the committee members, that'd be helpful. If you can send it to David. Any other questions from the committee members? All right. Now, at this time, what I'm going to do, because we have a little bit of time, I'm going to allow, I knew Todd had a question. Welcome back. Go ahead.
The gentleman to my right pushed my button, Mr. Chairman. I had asked him, and I guess I'll just ask real quick. It cost us $170 million in vendor compensation. Generally speaking, I know I got from Christine Murdoch the amount of sales tax that the state received in 2023. But since my laptop's not open, I'll just ask you, how much did we receive in 2023?
I can get that number for you. The only
Generally
number I
speaking.
have in my head is that we collected over 33 billion total, which is about 700 million more than Visa collected last year. That's all I have.
Okay, thank you.
I can get that number for you.
All right. Thank you very much. At this time, I will avail an opportunity for the folks that are in the room. If you have a specific question or comment that you'd like to share with the committee or ask a question of the Department of Revenue, I'm happy to do that. Again, we're going to have two more meetings, at least one, possibly two more meetings related to this, where we'll get to hear from specific retailers and merchants, as well as banks and payment processors at a future meeting. But if there's anybody that is just, as we say in North Georgia, chomping at the bit, they got something they got to get off their chest, I'm happy to entertain that. If not, I believe we have some lunch available in 510 for the committee members. I don't see anybody running to the podium. Okay, so everybody's hungry. That's good to know. If everybody is okay with it, I will let us stand adjourned, and we will notify each committee member of the next meeting. And my goal would be to give you at least 1 week notice, hopefully 2 weeks, but hopefully sometime in mid to late September, we will have our next meeting. Thank you very much. Again, food in 510. Thank you very much, Sean, for getting that. And this meeting is adjourned. Thank you.